Steve, welcome to the channel. How are you?
Yeah, good. Thank you. Thanks for having me.
Yeah, no problem. Look, if you could just introduce the viewers as to obviously who you are. I've obviously got a bit of a background on who you are and we've met before, but yeah, if you can just introduce yourself and tell us a little bit about what you do.
Sure, Ryan. So latterly, we've been taking the direction of crypto assets, digital assets, building a fund structure, both at the institutional level, the wholesale level, and we're looking at the retail level as well. Digital native assets is firmly aimed at the wholesale investor in Australia. And we built a global master fund out of Cayman, which is called TCM Digital Asset Fund. Before that, I was a Wall Street trader for many, many years. I ran large parts of Merrill Lynch in the early days, JP Morgan, and in the latter days, ANZ Bank here in Australia. I ran their global markets business, their global loans business, and for a while their institutional bank, which was about 40% of the bank. So I have a background in risk management and trading, but along the way I've run both the trading and sales sides of these various businesses. In investment banking terms, they call that FIC, fixed income, currencies and commodities, but also have run equities businesses as well. And I think crypto and digital assets is just an extension of that. So this is what got us interested in the crypto world and the digital asset world. And we've been focused on it since 2016.
Yeah, very nice. So you've had obviously quite an extensive background in the banking and sort of finance industry. You mentioned a few sort of, major banks you'd worked for in the past. I didn't actually realize that you'd worked on Wall Street. How do you see those experiences sort of shaping your journey into crypto?
Yeah, I think if you do go and work on Wall Street, it's pretty fast, furious and competitive. It's way more competitive than, say, working in Sydney or Singapore or even Tokyo, Hong Kong. London even lags a little bit behind New York. It's just a lot edgier. It's a lot faster. And, the brightest of the bright get there. So basically, as they say in that famous song, if you can make it in New York, you can pretty much make it anywhere. And I think that's true, right? I mean, I went over there at age 26 and was in New York and London for near 30 years. So a long time, both in the city of London and in Wall Street, and would spend quite a lot of time in both centers contemporaneously, because I was running one business called Global Foreign Exchange out of New York for Merrill Lynch. And I was running their regional European business for fixed income, currency and commodities out of London. So I was spending quite a lot of time between the two. And I think it just gives you that competitive element and competitive edge that when you do get back into what I call the more normal cities, you certainly have a lot more experience and you're a lot more, qualified, I think, to deal with global events as they come out. So, whether you look at in the beginning of 1987, where we had the Wall Street crash, you look at the Thai baht meltdown, 97, 98, and the fiasco with long-term capital, and the Russian debt crisis. You then get into the next big one, which was the dot-com bubble in 01. Then you get into the 2000 and 08, 09 Lehman and Merrill Lynch debacle with the GFC, the global financial crisis. We go along for another 8 or 10 years and we find that the world shuts down because of COVID. And to get back to the crypto side of things, if you've seen all of those events and you've been through them, as I have, then crypto, yes, it's volatile and yes, it can be scary for people, but it's not a lot different than the very early days in emerging markets, in local currency trading, in commodities trading, etc. So oil, electricity, gold can all be quite volatile as well.
Yeah, certainly. I didn't realize that you'd, obviously been a part of a lot of those significant events in financial history. Out of the events you listed, what one would you say was probably the most significant and why?
I think the 08-09 financial crisis was the one, because the other ones were kind of isolated. I mean, COVID was a man-made thing. I mean, in terms of the shutdown, globally closing down the economies. Whereas in 08-09, there was a moment there around Christmas time when I think Bush was leaving and Barack Obama was coming in and everything was kind of on hold. There was a moment that I thought the US and the global village of finance was on the precipice of absolutely going pear-shaped and shutting down completely. And when you tie capital markets to the real world and that happens, it's a scary moment because everything freezes up and people are very worried about their, their fortunes, their savings, getting money out of the banks. You saw bank runs. And when's the last time I saw a bank run? I've never really seen bank runs before. I saw a lot of counterparty risk. I saw a lot of failures in the 87 and the 98 debacles, but I never saw the world on the brink of complete financial collapse. And that's what we had in 08, 09. Whereas COVID, you could sort of see it coming. You could see economies closing down one by one, provinces, and then basically that would move to cities and then to entire countries. And you knew that the Federal Reserve had seen the video before, but for a different reason. So this time in the 2020 debacle in March, April, they were much faster to act. They got out the bazookas much quickly, much faster, and they fired them, and they did not screw around. And I think basically, and we'll get into this later around crypto, but basically they had no alternative because it was the governments along with the treasuries and the central banks that said, yes, we'll shut the world down to fight off the pandemic, but we're going to have to make up for it through, macroeconomic policy, mainly money printing.
How do you think they've handled the situation then with COVID? Do you think they've actually done quite a decent job, or how would you sort of describe what they've done?
It's a really interesting question because the bottom line, I think, for people to think about is the three following things. Is nobody wants to face austerity anymore. Nobody really wants to face a recession or a depression. It seems like we've thrown the R word and the D word out in the dictionary and we just don't want to do it anymore. So that then means, okay, what do we do? And it seems like what they're trying to do now is create inflation. And they're saying they're absolutely trying to create inflation. But what they really did is they reached for the money printer or the money gun as fast as they could and, shot it off. And they've been, printing wildly since. And inflation is an interesting thing, which I'll come back to. The third one is they could just default on their debts at some point. That is Western governments as well as more emerging countries. But that would be problematic as well. So you've got austerity, you've got inflation, you've got default, because you're sitting at some of the, the precipice now, at the lows in interest rates. You've got deficits to GDP as high as they've ever been. You've got, the debt level that the US is carrying as high as it's ever been, et cetera. It's printing more money in history than it ever has. So, you would think something's got to give. So to answer your question, I think they did what they could to kick the can down the road and, build the economy back up. And they would rather have full employment and some inflation rather than, high unemployment, no inflation and no economic growth. But most of the economic growth and most of what you're seeing in the financial markets is built on debt now. And it's moved from the private sector to the government sector. And, it's going to be a long road out of here. So I think they've done a good job short term. But if you're a smart investor, if you're a, well-read individual, corporation, whatever, then you're looking around for assets that are inflation proof, if not inflation fighters, so that your buying power holds up over the next 10 years, because we could get some serious inflation. And inflation means, there's three types. There's the monetary inflation, which is the debasement of fiat currencies. And that's happening, regularly around the world in most of the G10. And debasing of currencies just simply means that they'll all sit around together, but they're debasing against things like Bitcoin, gold, real estate, hard assets, good financial stocks, etc., good technology stocks. The second type of inflation is the one that we're all aware of, CPI, consumer price inflation. And that's a bit of an issue in my mind, because 90% of, the Joe Blow out there that's got his salary or his pay packet tied to something, well, it's tied to CPI. And CPI, consumer price inflation, has basically been null and void for a decade or more. And therefore, real wage growth has hardly been, growing at all. So asset prices and real estate, et cetera, have continued on, but wage growth have nowhere near stayed with it. And this is the big issue that they like to talk about in the Australian housing market. How does anyone afford anything? Well, the answer is we've dropped interest rates from 18% in the 80s to 1 or 2% mortgage rates in the 20s. So it's a more affordable when you look at it from that perspective. And the third inflation is asset inflation, right? So, and you could look at assets as things like university education, which could be an asset to, your son or your daughter or to yourself, house price inflation, stock market inflation, Bitcoin inflation, etc. And this is the real issue. One of the reasons that Bitcoin and crypto has become so much on the radar of alternate money managers is that it is proving to be quite inflation proof, probably more so than any other asset out there. And there's probably a few reasons for that. But my point is, if inflation's not running at 1, 2, or 3%, and it's actually running at 5, 10, 15%, if you listen to Mike Saylor from MicroStrategy, if you look at what Musk just did with Bitcoin, if you're looking at Julian Robertson over at Tiger, the guys that work with Paul Tudor Jones, etc., they're all worried about this now. And what's really interesting, we've got the world confused, is the rise in bond yields, the fall in the price of gold, and the continued savage rally of Bitcoin eats the world, right? So they don't line up and they get a bit confused. And if you're not across capital markets, global macro, the machinations of the technology of something like Bitcoin or Ethereum for that matter, then it can be very confusing. So part of what we do is try and sift through that, figure out what's going on, and combine our knowledge of blockchain, the technology, the crypto asset world, and the global macro and the global market and capital markets experience that we have.
Yeah, perfect. So obviously you've got quite an extensive background in the finance industry. How did you sort of get started in crypto? I think you've sort of finished working up for ANZ around about 2015, if I'm not mistaken. And then
That's
you
right.
sort of, so then you obviously transitioned into crypto. How did that sort of come about?
First of all, the banks were looking at it, and the consultants like PwC, McKinsey, etc., were all encouraging the banks to look at it in the early part of 2012, 13, 14. And at one point, I was responsible for running transaction banking as well as the global markets and global loans business at ANZ. And I was introduced to it by one of the consultants, and they said, "Steve, you got to look at this blockchain technology. It's it's super cool. It's going to be a game changer, etc." So the consultants were onto it, but it was hard to figure out what the applications were for blockchain and how it would work. And go back to first principles, etc. And blockchain is an extremely exciting technology. It's incredibly disruptive, and it completely turns one's head, from top to turvy, because bottom line is we're all used to a centralized structure where we're used to trusting banks, trusting governments, trusting treasuries, trusting central banks. I send Amazon the money and trust them, and I hope that they send me the goods. And so we've got this centralized, state-controlled world that we've lived in for, hundreds of years. All seems to have worked. But this technology has been created literally initially out of Bitcoin in 08 and 09, back to the GFC moment, that has shown the world that you can live in a decentralized, distributed ledger technology world in a trustless environment, which just simply means if I'm transferring electronic value across the internet from one wallet to another, I don't have to rely upon any central intermediary or counterparty to get the trade done. And I don't have to even know who you are as long as I've agreed to send that money to the wallet. And therefore I don't have to take counterparty risk because I've obviously done something on the other side to null and void that. And when you really get into smart contracts and Ethereum, etc., and you think about an atomic swap, where we're swapping value real time on the internet using blockchain and cryptography on a distributed ledger, that is a super cool, unique, and very innovative, disruptive invention that the world's still catching on to. So we were looking at the banks, and we thought it was pretty interesting, but like with everybody, we had busy day jobs, and everybody basically, I think, in the early teens there, were looking at it as something that was creative, but how do you implement it? What do you do with it? We all know that blockchain can record something going from over there to over there, you know, it could be rainforest timber from Brazil going to China or whatever. You can, you know, account for it on a distributed ledger. Then you've got the banks getting involved in the private permission ledgers, etc. So it is, I suppose, a fairly invasive invention into the world of finance and the world of banking. And I think there's a lot of applications there. This is why the banks have been paying attention to it. And it was only when I got out of ANZ at the end of 15 that I really had time to start focusing in on it in a big way. And we, you know, we went down the rabbit warren on many of these crypto assets, currencies, whatever you want to call them, and also learned how to tokenize physical assets like Perth Mint gold or home equity in the United States, etc. So blockchain allows you to do things that you couldn't do before, is probably the bottom line. And once you embrace it, you understand it, and you try to learn something about it. I forget who it was the other day, but one of the big crypto people that were early on said, show me a person that actually understands Bitcoin that then says, oh, it's a fake. Because if once you understand it, it's very hard to argue against it. But if you don't understand it, you'll argue against it all day long. Because it completely turns your world upside down. It's just not our DNA, as in the way human beings have been, you know, environmentally set up for the last few hundred years.
Yeah, I found that to be the case as well. You speak to anybody about Bitcoin and they've heard of it, but they don't really understand what it is. And they're just very like put up roadblocks left, right, and center. They don't want to really hear about it or accept it or even learn about it, which I find quite funny. You mentioned on an interview that you did with, I think it was AusBiz TV, and you had a really good three-part definition of what Bitcoin was. Would you mind just walking us through that? I think
so it is three things when you think about it. And I think Satoshi Nakamoto, whoever they are, he, she, or group, I think they set out when you read the white paper to do two things. And then I think the third thing's just come along, and they may have known about it, they may not have, I don't know. But the first thing was to be able to electronically move value across the internet safely and securely, peer-to-peer, without a central intermediary or rent seeker of some, you know, concern. And that was the first thing that they wanted to do, and they achieved that. That's no problem. The second thing they wanted to do is create a digitally scarce asset that could rival the hardest money in the world. And I think they did that on purpose, both through the halving every 4 years of the Bitcoin from 50 at the beginning, you know, every 8-minute block, down to 25, down to 12.5, and now it's 6.25. And of course, we go to 3 1/8. We're just under 19 million Bitcoin today that have been mined and minted. There's a total of 21 million. And the second part is the cap, right? They said, right, we're going to halve every 4 years, which is the exact opposite to what money printers are doing. They're adding 15% money supply every year. Right? So that compounded is serious money supply growth and serious debasement of the fiat currency. So they created this hard digital scarce asset that you could electronically move securely from peer-to-peer without a central intermediary or counterparty in the middle. And I guess the third thing is, once you think about Netflix as the video network, and you think about Amazon as the retail network, Facebook as a social network, and so on, then what is Bitcoin? Well, it's a money network, and it could be bigger than any of the networks out there. And so I think this is why the Winklevoss twins, when they were introduced to it in Ibiza, of all places in Spain, got involved, because they're like, well, wait a minute, this is not only hard money, this is a network. And they understood what Facebook had done and what it was doing. So once you combine the first two with what I think is the network effect and the ability to create a technology that is world changing, which is underpinned by the blockchain, then you've got something like an Apple or like an Amazon that can grow exponentially. And interestingly enough, with an open network like Bitcoin, then it is open to, 7-8 billion people in the world. When the internet started 20 years before the internet became popular, less than 0.5% of the people use the internet. Today, 60% of the world use the internet. Well, guess what? 0.5% of the world uses Bitcoin today. So you look at over the next 20 years, it has a pretty interesting trajectory as where this all might go. So I think it's this innovative creativity that's in there as well that is driving value. It's not just people speculating, they're actually joining the network. It's becoming stronger as more and more people join it. And I think it's this creativity, this ingenuity that, this is why people say it's 10 times better than gold, because Bitcoin, unlike gold, does two things. It moves across time and space, whereas gold is really good over time, but it's not very good at moving across physical space and geography. So I think there's this, technology bent to the Bitcoin, monetary energy battery network that these guys have built.
Bitcoin seems to cop a bit of flack with its volatility. I've heard Michael Saylor talk about this as well, whom you mentioned earlier, talking about the market cap of gold obviously being around about $10 trillion. Bitcoin's only just sort of recently crossed over the $1 trillion mark. I think he predicted that stability would sort of start to come around about that $10 trillion market cap. Do you also sort of foresee that sort of happening as well?
Yeah, I do. It's interesting. Michael is a aeronautical engineer from MIT who's no slouch when it comes to understanding an engineering problem. And he's approached it from an engineering background, this whole Bitcoin question. And he's also extremely eloquent and articulate about putting something across to the audience, whether he's talking on a podcast or he's in a live situation, etc. But the one thing is, we were thinking this from a macroeconomic point of view and a technology point of view before I'd heard of Michael Saylor. And so I was coming at it from well, hang on, the world was printing money back in 08, 09 to bail out the banks. And that's why Bitcoin was created and started. And then this time around, the world was printing money to bail out the real economy and everybody else because they closed it down, because that was their response to COVID and the pandemic. And it seems to me that we're at a very dangerous intersection here, because if there's a problem, a financial crisis, a natural disaster, a pandemic, whatever, the first lever we tend to go for is the money printer. Not taxes, not austerity, not, let's manage the economy through this, let's just print the money. And I've never seen anything quite like this in my 40 years of looking at this stuff. And so he's approached it engineering-wise, we've approached it macroeconomic and capital market, global market-wise. And along the way, we've got to understand the technology as well, because we're not technologists. We're actually asset management, financial people that have grown up in the global capital markets. But once you combine your knowledge of that, where Michael came from it at an engineering point of view, and us understanding that technological advantage that, say, Bitcoin's got over gold or other financial assets, well, then it's a slam dunk. So I think he's been a good champion, or a great champion for it, from a corporate perspective, from, okay, we're going to put it on our balance sheet, we're going to protect our position through holding Bitcoin. Whereas if we hold cash, we may as well stick it in the liability part of our balance sheet, because it's depreciating by 15% per annum, which you only have to run for 5 years and you've lost 100% of the value of your cash, or the purchasing power halves every 3 to 5 years. So he's trying to protect that company and that balance sheet to make it fortified come hell or high water against serious debasement of the fiat currency. And he approached it from the point of view of saying, I've got this ice block sitting in the sun. It's called my cash pile. It's melting really quickly. So what is the best financial asset I can buy to protect the company and myself from, economic suppression? And his answer was Bitcoin from an engineering point of view. He thinks it's way better than gold, way better than real estate, certainly way better than US treasuries. Most people don't understand that when you own duration in bonds and fixed income, when yields go up, prices go down. And if you're forced to sell, it's just like an equity instrument. If you're forced to sell when equities are off 30%, as they were in March of 2020, well, you're out of luck, and it's the same with the bond market. That the yield is not fixed. The coupon is fixed, and you will get that coupon until the bond matures if the government stays in business and pays you back the debt. If they don't, well, you've got a bit of a problem. With Bitcoin, that can't happen. No state, no government, no company, no one person controls it. And that's why all of the hype and the interest from the alternate asset managers, both big and small, is starting to happen. I think MicroStrategy, I think Elon kind of bullied into it by Michael and a few of the other guys. And I think that some of the smartest macro minds in the world, as I've mentioned, have figured this out as well. And quite frankly, we've been expecting the wall of money to show up probably, I was thinking 19 prior to COVID. And it was just ticking along. I think Bitcoin would do what it's done, except a bit slower without COVID. It was going to do this. It was always going to do this. And, if you think about it too, Ryan, if you think about when we were in 17, we had the FOMO, the fear of missing out, the hype, the retail person jumping in. There was zero institutional interest, knowledge around the sector. They just weren't interested. And you had some hard forks. So you had some questions about, is Bitcoin really capped, or can you just create it and create it? You had no infrastructure for institutions to get involved. You had no risk management systems. You had no futures contracts. You had no options contracts. And you also had no real regulation clarity around it. Now, all of those things have changed to the better for things like crypto assets. The OCC, the Office of Controller on Currency, has said it's fine for JP Morgan or Wells Fargo to custody crypto assets. You're looking at Coinbase doing its IPO sometime in 21 at 100 billion market cap or more. For the SEC to let that go through, every token that Coinbase trades means that it is not a security. It's a utility of some form. So otherwise Coinbase, by its second derivative, wouldn't be able to list. Put that in perspective, I haven't looked at the market cap of Deutsche Bank lately, but I imagine it's probably 7 to 10 billion euros versus 100 billion market cap for a crypto exchange and custodian managing $90 billion of people's assets, which is only going to grow, right? And they're only going to grow with it. So, yeah, I think, that more and more smart people are coming. And I think the tsunami of debt that has washed over all of the world's traditional assets, whether they be bonds, real estate, equities, fine art, whatever it is, gold, and Bitcoin, the tsunami of debt that's washing over it is driving those asset prices higher and higher, because we can't create new Apples, like they're a dime a dozen, and Amazons, etc. And that's why they're looking into this alternate space in a big way now.
Yeah, awesome. Look, you brought up some really interesting points. One of them I wanted to touch on was, so you mentioned the 2017 sort of bull run that Bitcoin went through. Obviously, the price sort of peaked at just shy of, I think it was around about $20,000 US. And then obviously we sort of went through what people refer to as a crypto winter. We, saw prices drop from, $20,000 roughly down to about $3,000-4,000 US through March 2020. What do you sort of see the main differences being between the 2017 bull run versus where we're sort of sitting now?
It's institutional belief. It's as simple as that. COVID sped it up. It's institutional belief. They've done the work. Some of the smartest minds in the world have done the work with their boards. BlackRock is an owner, I believe, in MicroStrategy. I believe Rentec, Renaissance Technology, one of the most successful hedge funds ever, is now a big owner in MicroStrategy because they own so many Bitcoin. But I didn't quite finish that answer for you, volatility and Bitcoin. Well, it's been to the right and it's been up. And when you hear the 9 o'clock news, you kind of hear the share market had another volatile day today and ended up down. Somehow or other, we equate volatility with a down market. And actually, there's good volatility where you can create alpha in your portfolio, particularly with a zero correlated asset class like crypto, where it's not like you're long all the usual suspects and all the same things. Long being that you've got an open position where you've got exposure to that asset class from the long side or from the positive side. So if you think about the volatility, I always hear the usual arguments, and one of them is, oh, it's so volatile. I'm like, the way you manage that volatility, and where I think every skeptic in the world will eventually be brought to their knees over this, is that you only have to have 1 to 5% of your portfolio in it, because it is volatile. Nobody says it isn't. And when does it max out and become and find its equilibrium? Well, I think he's right. That is Saylor. I don't think it's until we see Bitcoin go through the market cap of gold, which is $10 to $12 trillion. By the time it gets there, gold may have a $20 trillion market cap, because the traditional world are going to buy inflation beating assets, which, just simply means gold doubles from 1800 US dollars an ounce to 3,600. For all I know, it could trade 5,000. So Bitcoin's got a ways to go, but I think it can happen within 5 years. I've always been more aggressive. We have been more aggressive on the timeline because we understand markets. Markets do not screw around. Once they're onto something and they know where it's going and they understand why it's doing it, both fundamentally, forget technical, but fundamentally why it's doing it and the technology that comes with it, then the markets will take it there a lot faster than what people realize. So yeah, I think there's a perfect setup now. And the big difference is the institutional framework with institutional infrastructure. And so like at Digital Native Assets, we use TCM Global Asset Management, which is a fund offshore. And they have a setup that is very institutional investment grade setup, where they've got 2 types of protection for people that invest into their fund. The first one is separate custodian from the investment manager, so that the money manager is never really handling the crypto, the private keys, or the cash. And second of all, they've got independent counterparties managing the process. And that would be people like KPMG, who's the external auditor. You've got people like Mainstream, which is an Australian Stock Exchange listed company, as the administrator, who do the KYC, AML, know your customer, anti-money laundering, onboard you, do your independent NAVs at the end of each month, and also help you with your redemptions once you go out of that fund. The third thing is you have an independent banking structure, and those guys use Signature Bank in the US, which is FDIC insured. And then finally, the custodian, which is Kingdom Trust at this point over there in the US, I mean, they're operating on a multi-sig environment, so their multi-signature sign-off environment, so their employees and partners, etc., can't run away with the keys or the crypto. So if you combine, independent custody with those verticals, you need an awful lot of collusion across geography and various public companies for something to go wrong. And the one thing that the audience should know, and most people that understand crypto do know this, that the number one issue is security over those keys, right? And because they're bearer instruments. If you send them to the wrong address, if you're loose with your private key, it's like giving the key to your house out to the local burglar. He is sure to visit and burgle you because you've given him the key. And so, but therein lies the beauty and the beast, right? The beauty is that they're bearer instruments and you get instantaneous change of ownership, change of property, change of legal title, and therefore clearing happens straight away. And therefore you don't have counterparty risk, but you also have to know what you're doing, because if you've given the crypto to the wrong wallet, you can't call up a bank and say, I need my crypto back, because there is no bank. So this is why I think it's taken a while, and all this infrastructure that's been built, Gemini with State Street, Fidelity Digital, as a sub of Fidelity, JP Morgan's getting into it. Even Jamie is going to have to eat his words again over there as the CEO and chairman of JP Morgan, because he initially addressed it as a fraud. And he said, if I catch any of my traders, I'll fire them. And now, you know, I think JP Morgan are right on the precipice of issuing a Bitcoin ETF or a Bitcoin lookalike product that its clients can get exposure to via a structured product through the bank. So, you know, one by one, those dominoes are falling. Even Ray Dalio didn't really care for it. Now he's done some work on it and currently sees it as a store of value that could rival gold, basically. And at some point, he'll come completely to his senses and say, this is better than gold. But we've got to give him a little bit more time to get there.
Yeah, unfortunately, these things do obviously take a little bit of time. Look, you mentioned JP Morgan, you know, potentially being at the forefront of an ETF sometime in the future. I think an ETF was recently released in Canada as well. Do you foresee the same sort of thing happening here in Australia? And if so, how long do you sort of, you know, think that'll be?
Yeah, no, it's interesting. The Australian Stock Exchange has told us that they're getting ready to launch and issue an ETF in Bitcoin because we rang them up and asked them. And we think that bottom line is we'll probably see that in the next few months, as long as the Australian Stock Exchange and ASIC can agree on the rules of the road. And a lot of the knockback of ETFs in the US so far has been around, well, the liquidity and the price discovery. And it was just another reason why regulators, like, you know, there's the volatility argument, there's the electricity argument, the use case for it, etc. There's the, well, I don't understand it, it's a Ponzi scheme argument, which is completely ridiculous. Because once you understand how that distributed network works and how it's secured and how it's verified, then you go, well, actually, that's quite a neat invention and it's digitally scarce. So I don't know. I mean, I think, you know, I've coined the phrase before that I think Bitcoin's like the Mona Lisa of money. It's kind of priceless in many ways because it can't be hacked, it can't be counterfeited, it can't be double spend, it's immutable, it's verifiable, and so on. It's transportable, it's highly transportable. And we in the West think about, you know, our safe banks and our safe cash. And in the emerging markets, they worry about, you know, ravaging inflation, being taken over by the army, etc., like in Myanmar recently. You know, or you've seen it in African countries, etc., South American countries. Argentina's gone broke twice. You don't want to be long their local currencies because as a store of value versus the rest of the world, they're not very good. And then if the rest of the world's currencies have got their own issue now because they're all printing away merrily. So yeah, look, there's, as I say, there's lots of reasons. There's too many good reasons of why you've got to have a piece of this, and there's not enough negative reasons. And in fact, I think you would take career risk if you were involved in this as an institution 3 years ago, as an employee or a partner of an institution. That pendulum has swung to you're taking career risk if you're not involved.
Yeah, very interesting perspective. I like that. Look, you recently, sorry, you earlier on mentioned talking about tokenizing real world assets as well. So I think you mentioned things like, you know, property, things of those sorts of that nature. How does that sort of look? Like how would someone obviously go about doing that? Is that more like obviously at the moment we see a lot of speak about NFTs being the next sort of trendy sort of thing within the crypto space. Is that sort of where you think that technology might head?
Yeah, well, NFTs are completely digital, brand new things that they are creating, right? The non-fungible token should be only one of a kind. You know, there might be a series of 6 ever done or something, but they're digital art, they're digital music, they're completely native to the internet. What we call the STOs, the security token offerings, and the commodity-backed tokens, like we did the Perth Mint Gold token on the blockchain, the Ethereum blockchain, they're real world assets that have been tokenized. So why would you tokenize a real world asset? It doesn't really change the underlying economics of that asset, the performance of that asset, or of a New York skyscraper like the Chrysler building or whatever, will do the same thing. It will still be the same economic outcome. But it democratizes the way the world can invest into that New York skyscraper or into the gold at the Perth Mint, because the digital application or the tokenization is infinitely divisible. as you know, there's 100 million sats in a Bitcoin. So it goes to 8 decimal places, which is pretty divisible. And so if you can divide up a kilogram of gold into 1 million bits, so somebody in India can own, 1/millionth of 1 kilogram of gold for, $20. Well, in his digital wallet or her digital wallet, they have $20 of gold, safely and securely stored on the, in our case, the Perth Mint gold token on the Ethereum ledger. So why else do it? Beside being divisible and beside being much more democratic for investors to come into, it just opens up the capital market to a much bigger pool of funding. So therefore, by tokenizing assets, not only are you securely storing them on the blockchain and recording and verifying the actual real value and the real entity that you're tokenizing, the ability to track across the blockchain as well, the ability to be infinitely divisible, and the ability to open it up to, again, Joe Blow in the world, then what you're going to end up with is a 24/7 tokenized market of everything. So if, for example, I did own the Mona Lisa, and if, for example, it was worth, I don't know, $1 billion, well, I could open it up to 1 billion users at $1 each, and then 999,999,999 other people could own it with me. And I think that's pretty cool, right? So why not use that technology, which is cheaper, faster, more secure, and it's fraud proof, basically. It's immutable, as I've said before, and irrefutable. Why not use that technology to record value across the internet? And that's the big deal about Web 3.0, moving value rather than just data securely across the internet. That's a big deal. That's a big invention. And coming from the financial world, I understand that, but people are still coming to grips with that. Sorry. The other one we did was, we did something called Phantom, which was a DAG-based blockchain, a direct acyclic graph, which is a super fast blockchain. Right? And Phantom at the moment is involved with a number of projects in emerging markets like Afghanistan, etc. And because it's a blockchain and because it's quite quick and can rival things like Visa and MasterCard, etc., in terms of settlement time, there are use cases for it. I mean, it can be used in smart cities for working between the traffic lights and driverless cars. It potentially could be used, for air traffic control, where you've not got humans doing it. You've got a blockchain doing it on smart contracts. It can be used in DeFi, in the decentralized finance space, and so on. So these things have come up from literally nowhere because smart entrepreneurs have, discovered how to use the blockchain and real world use cases, what we call decentralized applications or dApps, on these new protocols. And then you've got the world working on them because they're an open protocol. So you get all these people working on them, you reward them with some Phantom tokens in the case of Phantom, etc. And that is a true initial coin offering that was done in 18, of which we launched, etc. And then you go to the other end of the spectrum, Perth Mint Gold Mint. The Perth Mint said, look, we'd like to create a digital ledger for our gold, but we want to control it centrally, which is the old way of doing things, but it allowed people on an app, on their phone, to buy a small piece of gold. It's digitally infinitesimal, so you can do whatever. But then they said, we'd like to try the blockchain, and how does that work? So we took the Perth Mint Gold Pass and we tokenized that and put it onto the Perth Mint Gold token onto the Ethereum blockchain. And then the last one, the real estate market. Imagine in California, there's $5.1 trillion of primary owner occupied housing value that is leveraged less than 70%. So the owner's living there, they may have a mortgage of 50%. They want to keep the house, they don't want to move, they want the full utility, but they'd like to take some money off the table. You can literally tokenize the equity in that house, along with tokenizing all the equity in all the other houses around them and the other counties, etc., all the way up and down California. And you might create a $600 billion to $1 trillion opportunity for institutions and pension funds to invest into and partner with owner-occupiers. But now they're into the residential housing market, which throws off an interpolated or inferred yield of sort of 6 to 7% unleveraged. And of course, with bond yields at somewhere between 0.5 and 1.5, that's pretty attractive, you know, for pension funds, etc. So the blockchain, by recording that on a blockchain, and in this case, it's called Homium, and they're doing it with Credit Suisse on a private permission blockchain. When you think about that, you've opened up a whole new market because of the technology, of the use of that technology to be able to record it and make investors feel safe about that it is immutable, irrefutable, and all the good things that we've said. Well, that's super cool. So it's created a whole new market. And it doesn't just have to be pension funds that want to go long California real estate. You may want exposure to, you know, Santa Monica, which is on the beach in California, in LA. And you could buy into the Santa Monica Homium token and get exposure. And your bank might lend you 50%, so you can double your bet and so on. It's that technology that's allowing this tokenization of everything.
Look, while we're on the topic of, I guess, sort of, you know, altcoins and alternative assets within the crypto space, are you guys at DNA looking at stuff like this? You mentioned a few different, you know, products there, you know, tokenizing property. You mentioned that you obviously successfully tokenized some of the gold holdings at the Perth Mint. Are you guys also looking at, you know, other alternative assets to Bitcoin within the crypto space?
Yeah, so look, I said this the other day on the TV interview, because I think if you can sort of break it down and keep it simple for people, because a lot of people will probably want exposure to the space without really having the time to understand the space like we do. And so if we were setting up a gold fund tomorrow, we would say, look, we're going to buy some bullion and keep it at the Perth Mint. And that's Bitcoin. Bitcoin is bullion then. It's as simple as that. And once you've got your head around that, you'll always consider it as a bullion, but it may be bullion squared or bullion times 10. I don't know until we get there. It's just faster, better, meaner, leaner version of a store of value. And, you know, man, woman, etc., child are very, very creative and ingenious people. And this is what sailors recognize, right? The engineering, the mathematical code behind Bitcoin is something to behold. It is, you know, maybe it's the eighth wonder of the world. We'll see. So that's your bullion. Your Ethereums and the decentralized applications that get built on them are your sort of the nuance of mining. They're the proven ones that are out there. They're the biggest, you know, the biggest use of any blockchain is the Ethereum blockchain now. And there's a lot of applications being built on Ethereum. And some of those dApps, those decentralized apps and new protocols, they're your explorers. And your explorers are the riskiest part of your portfolio. So, you know, generally explorers are smaller in market cap than the big ones. It's like saying that you're going out to look for iron ore, so you're going to compete with Twiggy Forrest in Western Australia, Gina Reinhardt, and then Rio Tinto, right? And you're going to call yourself the Ryan Iron Ore Fund. Okay, so you've got to go get some explorers. You've got to figure out, okay, well, but I've got to keep the money safe. So I'll buy the underlying iron ore spot price at 160 and keep that as my bullion and so on. And then in the middle. So my point is that's what we do in crypto. Most of everything we do in crypto so far is what I call native digital assets, where they're not security tokens and they're not commodity-backed tokens like gold. They're typically in the top 20 cryptos by market cap. And we typically use TCM, Global Asset Management Investment Manager, to do the following. They typically sit in about 65% Bitcoin, maybe 70%, another 10 to 15% in Ethereum, and then they sit in the explorers. And, you know, the explorers could be Neo, it could be Cardano, it could be XEM, it could be Theta, could be synthetics. There's a whole bunch of them, as you know, that are up and comers. And I think the question you asked me is, well, will you guys move into the more, I would call mundane but asset-backed world? And of course, we're working on products with the investment manager to do that at the DNA level, at digital native asset level. So I would anticipate we roll out a pretty vanilla, easy to understand, regular type crypto exposure. And then we start rolling out some of these other assets as they come on stream. And then, you know, we may end up offering the wholesale investors a DeFi fund, for example, so that they don't have to try and worry about yield farming and, you know, coin borrowing and lending and what's going on there. And we work with some very exciting people in the DeFi space across from Phantom and so on, people like Andre Crunchy. And if anyone wants to know anything about DeFi, he's one of the main players in the space. So our firm and also the TCM Global Asset Management, the investment management firm, you know, work with people like this to look at new ideas and products.
Yeah, perfect. Look, I think back in 2018 was a relatively difficult year for your company. 2021, what's the forecast sort of looking like? I'm presuming it's obviously quite good. Things are pretty good in the market at the moment.
Yeah, so the strategy that we're deploying today in 18 was down sort of 18 to 20%. In 19, it was up 29%. In 2020, was up about 231 to 235% gross. In 21, that strategy gross is probably 100% year to date. So, you know, we're in obviously early March now. My outlook for what it's worth is, and I try not to predict prices, but I think, you know, you sort of got to get off the fence and talk about these things a little bit. And my view is we'll see Bitcoin, you know, come the year end, somewhere between $100,000 and $200,000. I think within 3 years, we'll see Bitcoin trading at $500,000+. And I think within 10 years, we'll see it trading somewhere between $1 and $10 million per Bitcoin, which is pretty exciting in that if you got all the way to $5 million, you'd be at a $20 trillion market cap, but so will gold be. So it hasn't done anything. And some people think it's 10 times better than gold. What would drive Bitcoin to 100 trillion market cap? And I think it's pretty evident. The first go around was with retail and the hype without really understanding what was happening. The second go around is the institutions, and they're in the gold phases, I call it. And the institutions manage with retail about $950 trillion of financial assets and real estate in the world. If 3% was to come across to the crypto asset space, then you'd have $30 trillion. The market cap today is $1.5 trillion. So that's sort of 20x from here. Or if you listen to the OECD or the IMF or the World Bank, they talk about 10% of GDP, of world economic activity, will be on the blockchain within a few years. Well, last time I looked, you know, pre-COVID, post-COVID, after we get going again, that's 120, 130 trillion, and the US is 20 to 25 trillion, just to put it in perspective. So 10% of that's sort of 12 trillion. Okay, so that's a little less than the 30 trillion. But the big one is, what if I'm right, we're right at DNA and the investment manager over at TCM, what if Bitcoin starts to eat the world? What if, as other people have called it, it is the biggest predator on the block? And what if it's the hardest currency known to man ever? And what if people start using it as a global store of value and a global trade vehicle, because it's beholden to no country and servant to nobody? And what if that happens? Well, if the world's got a quadrillion in it, and today, which is 1,000 trillion, and by the time we get there, if we grow it, 3, 4, 5% on that base over 10 years, then it's going to have 1.5 quadrillion, right? Which is 1,500 trillion. Well, for Bitcoin to be 100 trillion of that, I could see that. So that's a pretty exciting thing to look at. And we haven't spoken about some of the, the explorers, as I've said, but I can see how some of the smaller ones can go faster, and I can see how 90% of them can go broke. That's why we don't take a lot of exposure to the little ones yet. And I can see how something like Ethereum, if the world locks onto it, possibly more valuable than Bitcoin in the short term at some point. It's trading at maybe 20% of the market cap of Bitcoin. So I think we're early. I think the adoption curve, the S curve as they call it, we're still very early stages. And it's that momentum, it's that power in the wall of money that's coming that has been combined with the debt tsunami that's been created by the central banks around the world, there's way more money chasing way less or too few of assets. And this is why you've got volatility in the price of things like Bitcoin and Ethereum, because they're small market caps, right? One's 200 billion, one's just under $1 trillion. They're not like the equity market cap of 150 trillion, or the fixed income bond market, which is 130 trillion, with 30 trillion of that at negative yields. And here's the other thing that most people don't realize, and I mentioned duration before, which is just simply the average life of a bond that you invest into. What if people start to get worried about the government paying the money back, or they get worried about inflation? They have to buy something else. And if they sit in cash, that's debasing fast as well. It's just a short-term treasury bill. And the further you go out the curve, the riskier it becomes because of duration and price sensitivity. So what do you invest into? Well, you're already long stocks. You're already invested in bonds and real estate and commodities. So what's new? What's alternate? And what is the smartest money in the world doing? They're investing in crypto assets, because Bitcoin is a scarce digital asset that can be used to move value safely and securely, the internet of value. The Ethereum is building the oil of the Web 3.0 to allow for people to use smart contracts to settle pretty much anything and everything. And that's massive. Those two by themselves are going to become giants, if you ask me. And I don't think it's long before the Bitcoin network is bigger than the FANGs combined. Might take 3-5 years, but it's going to happen.
Look, we mentioned Michael Saylor with MicroStrategy investing in Bitcoin. We've seen obviously Elon recently invest through Tesla, a couple other major companies and stuff around the world doing the same thing. Who else do you sort of see jumping on board? There's a lot of speculation around maybe Amazon jumping in, Google, Apple. Do you see those companies potentially jumping in? And if
I think it's a matter of time. It's just a matter of time, Ryan. It needs to get to a big enough market cap for the Apples and the Amazons to get involved, but it will. And they can wait until it's big enough, and then they can deploy capital. And that's the exciting part about it, right? Because there's so many levels of society that have to invest into the crypto asset space that will grow it to 10, 15 and beyond $1 trillion. And it's just a wave that will keep coming. And sure, the wave will wash in and then wash back a little bit, and then it'll wash in further inland to these corporations, etc. But asset managers around the world are looking to replace some of their fixed income portfolio with alternate assets such as Bitcoin, Ethereum, and some of the smaller ones we've talked about. And where does that end? Well, it ends when everybody's got some, including central banks. And once you see central banks buying Bitcoin, then you kind of know we're closer to the end than we are at the beginning, right? And I mean real central banks. I don't mean, Nicaragua or whatever. I mean proper G10 countries go, oh, but I think that's years away, because they'll be the last domino to get it. And I don't think Bitcoin's a threat to the financial system. I don't think it's a threat to the US dollar. I think it's just a store of value that is easily moved across space and time, that will hold up, and it's just another alternate. It's a better alternate than a lot of the things we have in front of us. And particularly, people have always used this 60-40 stock or equity versus bond model. The problem with bonds is they've reached their 40-year bull market pivot of the zero interest rate, if not negative, and they're at that outer bound. It's like it can't get much better in bond world, but it could get a whole lot worse. And that's what's shaken everybody's confidence in the last week or so, is that bonds literally, tripled in yield, which means they lost 60, 70% of their value very, very quickly. But people don't understand that about bonds. They think they're safe. And, just on that inflation argument, I would argue very strongly that if you hold on to cash for 5 years, you better figure out how to have twice as much cash in 5 years' time to buy the same asset that you can today. And this is what you're seeing in real estate and all hard assets. And the harder, the rarer, and the more transportable, verifiable, irrefutable immutable asset that it is, the more reserve status it will take on. And that used to be gold, but there's a new kid in town.
Which I see a lot of people don't seem to like. They don't like the new kid on the block at the moment. So I find that quite interesting. People are very set in their ways. I spoke to a gentleman yesterday, my previous guest. He's a relatively well-known economist in the UK. And he made an argument against Bitcoin to say that, he doesn't see it going anywhere. The typical sort of argument of, it's eventually going to be a bubble. It's not gold. If gold were to, start losing its value, you can still make jewelry out of it, was kind of the preface to the argument, which I found quite interesting. Bitcoin, you obviously don't foresee, turning into a bit of a bubble like all these sort of naysayers are saying.
Well, so the bubble's a really interesting concept, right? It's like, you blow up the balloon until it bursts and you keep blowing into the balloon. But if the balloon's getting stronger, the more people that are joining the network, then the thickness of the balloon is getting harder and harder to penetrate. So I think the Bitcoin balloon, which is not a bubble, in my opinion, can get bigger and broader and wider because of the nature of the technology, which makes it stronger. This is what Saylor's picked up on. The surface attack of Bitcoin grows exponentially as more and more people join the network. If you and I are the only people in town that have a cell phone, well, we just have 2 cell phones and we talk to one another. If you give people 1 billion cell phones, the network is much bigger, more productive, and so on. So bubbles are an interesting thing, but I would argue the biggest bubble in the world today, if you want to look for if you imagine a diagram of the biggest bubble to the smallest bubble, I think Bitcoin's the smallest bubble, and I think government debt is the biggest bubble. Why? What creates bubbles? Artificial price manipulation by central banks around the world on a concerted, centralized effort, where they're just blowing into the same old balloon that doesn't get stronger as the debt grows. If anything, the thickness of the balloon gets thinner and thinner, and then eventually it pops. Back to my austerity, inflation, or default argument. And if you think about it, what is inflation? It's just the ability of a central government to rob its citizens of its money. So what are you doing? You're robbing Peter to pay Paul. Who's Peter? Peter's generally the older population because they're the ones resting and relying upon fixed income securities. And who's Paul? Well, Paul is the young person coming along that doesn't have a worry in the world when everyone's printing money and it's happy times. It's great, right? Inflation, and I'll repeat it, dollars and pounds used to be back with gold, and then they got off the standard. Sterling got off it in 1914, and Nixon got off it in the early 70s. And since then, they've had the printing press at their behest. So what does the printing press do for people? As long as your citizens believe in you, they'll keep buying your dollars from you. They'll keep taking them in terms of paychecks, etc. But if I'm inflating and debasing the currency that I pay you today, and I agree that your salary goes up by 2% per annum because that's inflation, yet assets are going up by 10, 20%, I'm actually robbing you blind. And that's what they're doing. And I'm not a conspiracy theorist. I did economics at university, and I look at it and I go, wait a minute, this doesn't add up. It just doesn't simply add up. So you've got to find, fortresses that you can hold up in while they do this, because they're doing it in style. It's called modern monetary theory. And the modern monetary theorists believe that, hey, we can just print money. And if the bubble bursts and inflation runs away from us and gets too hard, well, we'll just put up taxes. What's the big problem? And we'll stop printing money. Well, that video has been played before in the Weimar Republic, in some African nations, where you've got $1 trillion money bill kind of thing, and it doesn't mean anything. And it's just quite simple, right? If I've got a pallet of money sitting out of my deck right now that's $1 billion, and the government's printing it at 15, 20, 30% per annum, well, my pallet of money at the end of the year is worth 15% less. Simple as. Okay, so I just think a lot of people have figured this out, but they're only early and they're smart. And these are the Mike Saylors of the world. They actually think they're taking more risk staying in traditional financial investments than they are in Bitcoin. And if you listen to him carefully, he thinks that the other ones are becoming liabilities quickly, and there's only a few assets that you can rely upon, particularly ones that are driven by mathematical code that can't be debased, that can't fork left, right, and crazy in print, and you have these caps. So I don't know. I mean, the word fiat is Latin for by decree, and fiat currencies are issued by governments by decree. And we had, you've seen the Yap stone, the limestone on Yap Island, in the Pacific. You've had gold coins over the years. You've had bronze coins over the years. You've had paper money over the years. Pretty much every currency that's ever existed has failed. And, it's fair to say that Bitcoin may fail at one point or another for whatever reason. But I think that's a ways off. And what we encourage investors to think about is the risk asymmetry, the risk return asymmetry is so much in your favor for so little of your portfolio. Even if you don't have time to understand it fully, you can take a little bit of risk that can drive the alpha and the return on your portfolio in a big way. And so, if we're wrong, then so be it, we're wrong. And we're all fooled by the Bitcoin gods, but we lost 5% of our money. And if we're right, and we're right on the market caps that we've talked about, then we've made people extraordinary sums of money that's protected them against what I call, the irresponsible, irrational money printing that's going on.
Steve, look, one last question. I know I'm wary of your time. I know you've got places and stuff to be. So I wanted to just quickly grab your thoughts on digital fiat currencies. Where do you sort of see that taking the space? Do you think that's a good thing, a bad thing? Obviously, we're seeing the Chinese yuan, starting to become digitized in some sort of form. Where do you sort of see that taking the space?
Look, I think, again, you've got to remember that central bank digital currencies, CBDCs, are just an electronic digital version on a private permission blockchain of the current paper and physical coins that are out there for any sovereign nation. However, by doing that and embracing the blockchain technology that goes with it, albeit private permission, they're actually sanctioning what's going on with the blockchain technology, underlying Bitcoin or Ethereum, et cetera, number one. Number two, the CBDCs, where they will have an advantage versus cash or checks or wiring money to a bank account, I could simply send you, the young person, money to your wallet, a US dollar, an Aussie dollar, it doesn't matter. And I could put a smart contract in there that says, you can spend it at IGA, the supermarket, but you can't spend it at Dan Murphy's, the liquor outlet, or the casino. It won't work. The cash will only work, that smart contract will only work in a food or in a hardware store or whatever it is, or a college education, whatever it is. So by being able to be more pinpointed in a rifle approach about it rather than scattergun and shotgun, I think that will help central banks and governments manage the economy. It's entirely possible that they might look at the different socio-economic parts of society, and they might be able to say, the Reserve Bank of Australia might be able to say through a CBDC, we're going to pay the pensioners 3% or 4% on their money, and we're going to pay the young people 1% on their money, because they've got a lot longer to go. Because, when you're young, you're a time billionaire. When you're old, you're time poor, and you're running out fast, right? So those CBDCs, I think, are incredibly interesting for a variety of reasons, but it also means that society will adopt these technologies to enhance and better themselves. And I mean, way smarter people than me are working on these things, but I do see some big advantages for society. And I think some of those advantages flow over into that 24/7 world I talked about, where, it's embracing the technology, because initially with anything new that comes along and that is disruptive, people push back on it. They say, no, it's a fool's paradise, it's fool's gold, it's a Ponzi scheme, it's this, it's that. And then what tends to happen is the regulators, et cetera, realize it's not going away, because Bitcoin's like a cockroach. They've tried to kill it 50 different ways and it's still here. Well, then they start to figure out how to have people swim between the flags, which is just the rules of the road. And then what happens is the third part is the adopters say, okay, it's better than everything else, and we're in. And I think, we're still in that phase 2, if not phase 1, where people are still pushing back on it. And as you asked before, Stan Druckenmiller is no slouch. He's one of the best investors in the world. He used to be George Soros's partner. Why is he buying Bitcoin? Why is Tudor Jones doing it? Why is MicroStrategy doing it? Why is Elon Musk, who was at one point the world's richest man, and goes up and down like a yo-yo by 10, 15 billion dollars a night on his own personal net worth on the back of Tesla stock? Why does Kathy Wood at ARK Invest, who I think she's fantastic, with the ARK ETF investing into her first holding and biggest holding is Tesla. The second one is Bitcoin through the Grayscale Trust. She's looking at, DNA as in biotech. She's looking at AI. She's looking at blockchain and Bitcoin. And she's looking at store of electricity in batteries, a la Elon over at Tesla. I mean, that's what they do. I mean, all of these really smart people are somewhat pioneers, and they're out there in the frontier, and, they get swatted around, and they're literally on the edges of finance. But, the edges of finance, I've seen it over the decades become mainstream relatively quickly. And in this world, because of the platforms, the internet, the global connectivity, it happens way faster than you think. So all of these views around 10 to 20 years, I think, can be squashed into 3 to 5, 6 years. I think we'll see dramatic change.
Yeah, awesome. Steve, have you got any final thoughts? Anything that we haven't covered, or anything you'd like to mention before we obviously leave? Maybe one thing as well I wouldn't mind getting is just information on how to, research digital native assets and find a bit more about, obviously, you guys and what you do.
Yeah. My final thoughts are this. If you want to protect yourself from possible calamity, and I'm not saying the world's ending, I just think we're going to have a lot of inflation, asset and monetary inflation. You need to be thinking outside of the usual box that you've been in. The new box is something we haven't seen since the 70s. It's serious inflation. It's coming our way. And there are two sides to that coin. There are people that say, oh, don't worry, there's no inflation. And then there's the smart money saying that there's inflation coming. So as an individual, a corporation, a treasury, a foundation, a charity, you need to be thinking about. I mean, I had a family office from Western Australia yesterday ask me about their cash pile and should they own some Bitcoin. And my answer is yes, but just 10%. Don't go all in like Sailor. Just try it out. Learn how to use it and see what it does, et cetera, et cetera. And generally speaking, it will move to the right and up. And so we actually see ourselves as trying to educate people about the space. And so we've designed our website that way, digitalnativeassets.io. If you go on there, you see insights, you see news articles, you see what the world's seeing, what we see through the world's eyes. And we just put it there for people to, for wholesale investors to look at. And I think that, because it's an uncorrelated asset and because it's a very nascent early on asset, you're not meant to bet the world on it, but you are meant to have something in it because of its risk return asymmetry, which I'm sounding like a bit of a broken record, but it's kind of like you got to treat this seriously now because inflation isn't really 1 or 2%. I don't know what it's going to be in the end, but it's not 1 or 2%. And the compounding effect of whether it's 5%, 7%, cost of capital is growing to 10 to 15%, whatever it is, that compounding effect, which most people don't quite grasp, is severely debilitating to your portfolio unless you have the right assets. And so I just encourage everybody to do some research, look into it, take it on as part of the university of life and understand what's going on here because it's happening.
Steve, thanks very much. You've been, very educational. I'm sure the viewers will find the same. I appreciate your time as well. Thank you so much for jumping on. Appreciate it.
Cheers, Ryan. We'll talk soon. Good to meet you again.
You too.
See you.